What impact can rising interest rates have on your retirement portfolio? Hey, I'm Doug Ray, President and founder of the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover what interest rate risk is, how rising rates impact a portfolio, how lowering rates impact a portfolio, and how one would adjust their retirement portfolio to limit their exposure to interest rate changes. Don't forget to hit that little like and subscribe button there if you're so inclined to follow more of our Vault video series. And okay, Doug, let's go ahead and get to it. We did a video series a few weeks ago covering the 9 different types of investment risk. Interest rate risk was one of those. So in this episode, we're doing a deep dive into that. By the way, the other episode that I'm referring to, the link is right up there. Talk to us about what interest rate risk is.
Well, it's definitely one of the biggest risks you face as an investor, as a consumer, just about anything. Interest rates have a direct impact on the bond markets and the stock markets. The bond market, being the largest asset class there is on planet Earth, is directly affected by rising interest rates. And as you know, we've been in a rising interest rate market for quite some time. The Federal Reserve, Jerome Powell, they have been on a tear raising interest rates. So I think everybody understands the concept that as interest rates go up, the bond prices go down. So that has an impact on the overall bond portfolio, but it also has an impact on your stock portfolio too. Because think about it. As interest rates go up, the cost of borrowing for companies goes up, and that has a direct negative impact on their profits. And the smaller the company you are and the higher tech company you are, the more impact those rate increases take.
Very good. So you just kind of dived into my second question there, how rising rates impact a portfolio. As you said, we've been doing, the Fed has been raising interest rates for a couple of years now because we've had record low interest rates for a decade. We were really spoiled. If you had a mortgage or something like that, you were paying record low rates. But now that the Fed is raising those interest rates, let's say that I'm a retiree and I've got stocks and bonds in my portfolio. The Fed is raising interest rates. How does that impact my retirement portfolio?
Yeah, let's give you a prime example. Let's go back 2 years ago. The 10-year U.S. Treasury was trading with an interest rate of about 1/4 point. Today, it is almost 4%. It was a little over that not long ago. That is a gigantic move. So you buy 10-year treasuries and $1,000 bonds. So let's say back then you bought a $1,000 10-year U.S. Treasury and it paid you $1.25 1% per year. Okay? Today it's paying almost 4%. So in order for that bond that you bought 2 years ago to trade equally on the market, it's got to be discounted to the point where that 1/4 point, it's called a coupon, the interest rate, is yielding the equivalent of today's return, almost 4%. So that means you're going to take a discount from $1,000 to somewhere around $700.
So if you wanted to sell that bond, you're not going to get anywhere close to what you paid for it.
You're going to lose 30% on the value of that bond. Now, granted, if you hold it 10 years to maturity, you'll get your $1,000 back.
But you don't want to hold it to maturity if it's got another 20 years to go, if you're only going to be getting 1/4% on it for the next 20 years.
Absolutely.
Right. So it's kind of, all the numbers tend to even out with each other, right? If you did sell it and buy another one at a par value, the bite that you took on selling it cheap is probably going to even out if you had just held on to it all that time.
Yeah,
more or less.
Yeah.
Okay, so let me ask you the inverted question. How would let's say again, I'm a retiree, I've got 60% stocks, 40% bonds in my portfolio, and the Fed is now lowering interest rates. How does that impact my portfolio?
So when I first got into this business in 1988, that was exactly what was happening. Interest rates were way up here. I can remember distinctly at Merrill Lynch, we could get 10% money markets for our clients. But if you bought, like, say, a 30-year U.S. Treasury and it was paying 10, 11, 12%, and interest rates started going down, well, that $1,000 bond started growing to $1,100, $1,200, $1,300. So not only were you collecting a great income off of that bond, but you were getting super capital appreciation.
And then again, the question would become, do I want to hold on to this bond where it's paying me a really good interest rate, or do I want to take advantage of the really high price that I could sell it for right now and reinvest that money?
Exactly.
And again, it would tend to be, if the markets are doing what they're supposed to be doing, all prices kind of even out, whether it's you do sell it or don't sell it. In the end, it should be about even for you.
Yep, it should be. So at some point, if you've got a highly appreciated bond, you'll have to make that decision for yourself. Do I sell it, capture the capital gain, and move on?
Okay, very good. So last question here. Let's say I'm 65 years old. I've got a 60% stock, 40% bond portfolio. I'm about to retire, and I'm thinking for the long term. I'm not thinking what the interest rates are today or what they might be a year from now. I'm thinking for the next 25 years, I'm going to be retired. How do I design my retirement portfolio to shield me as much as reasonably possible from interest rate risk?
Very good question. You know, that 40% you have in bonds is definitely at risk. We don't know how much higher interest rates are going to go.
Or let alone what they could do again 5-10 years from now.
Right, exactly. So, you know, in our opinion, the way we model portfolios is we use fixed indexed annuities to entirely replace the bond portfolio, because that gives you stability. It can't go down in value, but the indexing inside of there is going to give us what is equivalent to 5 to 7% returns we got with 10-year treasuries, say 15, 20 years ago. On the equity side of that portfolio, you got to have some downside protection, whether you do it yourself mentally with 10% stop losses, or we have our own methodology that we use here in-house to protect our downside on the equity portfolio. But let's face it, folks, you're facing a 20-plus year retirement. Bear markets happen in stocks and bond markets roughly every 7 years. So you're going to go through times like this in the future. It's almost guaranteed.
Right. Very good. Well, I think that basically covers the main points that we wanted to cover about interest rate risk. That's going to wrap it up for this episode of The Vault. Feel free, again, to hit these little like and subscribe buttons there if you want to catch future episodes. And remember, the markets aren't going to wait for you. I'm Brice Payne.
And I'm Doug Ray.
And this has been The Vault.